Hello traders, Michael here from Rice Pirate Trading as well as optionsplayers.com. I'd like to get a quick video out, especially in light of the earnings season and the very much anticipated Apple earnings on the 2nd of November after market close. Very, very much anticipated as we have both the release of the iPhone 8 as well as the iPhone X, or otherwise known as 10. So I'd like to present why I don't play earnings with Apple in a very detailed way. And as we mentioned, we have the earnings coming up on Thursday after market close, AMC. And what we have here is we have a regression line in the middle and a one standard deviation out on both sides. And you can see that Apple pricing right now is darn smack right on that regression line. Which means it could go either way, and it can go a lot or it can go a little. So what we can do when we do play earnings with options is there's a number of things that we can do, but primarily what people will do is they'll either go directional with calls or puts. If you think it's going to go down, people will buy puts. If you think it's going to go up, people will buy calls. Or you can go non-directional with the straddle. Quite frankly, if you go directional, it's a crapshoot. You really don't know what's going to happen. They could announce really fantastic earnings, but the market will send it down, or they could announce really crappy earnings and it could send the stock price back up. So usually what I like to do is I like to think about my trading based on what if I'm wrong, especially with respect to what I lose. So a loss of 10% obviously necessitates a gain to recover back to normal, which is 11%. But the more you lose, the more you have to recover. So if you lose 80% in a trade, you're going to have to gain 500% to get back to where that investment value originally started. What this means is, for earnings, because it is such a crapshoot, I will not take a directional position on options. I do like to think about, as long as I back test it over many, many, many earnings, the concept of a straddle on earnings. Okay, so we're going to either take it up or we're going to take it down. And if it goes up, we can earn, and if it goes down, we can earn. But it comes with a caveat. So I'm going to take a case study of Apple earnings for the past several earnings, past 8 or 9 earnings. And what we're going to do is we're going to buy the nearest at-the-money calls and puts at the end of the day on earnings day, just before the earnings announcement, just a couple of minutes before close. A straddle is going to profit if the price moves more than the combined premium of the calls and the puts. The combined premium of the short-term straddle is also called the implied move of the underlying post-earnings by expiry. However, we need to have a lot of caution in this because implied volatility is pumped up just before earnings, and it's going to crush immediately following earnings. So if the price move of the underlying is small, the value of the straddle will decrease significantly. We call that volatility crush. So I'm going to be using Tom's options tools, to do a little bit of analysis for the past. Okay, so this is the front page. And we're going to go back to April 26th, 2016, which was earnings day. And we're going to buy a straddle. And you can see that we bought a call and a put. The combined price was $515, and we had a downside break even of $98.85 and an upside break even of 98 or 109.15. This is the implied move of the stock for earnings. It's a short-term straddle. So the market makers think it could either go up to 109.15 or down to 98.50. I'm sorry, 98.85. So what happens after earnings the next day? It opens up down here, and then it rises. Okay. At the end of the day, that straddle is worth 21.4% ROI. Now, the stock itself changed $6.53 or 6.26%, but the straddle only earned 21%. That's because of volatility. And what happened is, the red line represents the short-term volatility, as volatility crushed. It declined, and it reduced the value of our straddle. Another example, October 25th, 2016, we have a straddle at $531 with 118 calls and puts with 3 days to expiry. And we're going to hopefully get a nice earnings and take a move. So the implied move obviously is down to 112.69 or as high as 123.31. But what happens on earnings is it doesn't really move, and we get a massive volatility crush, and we get a negative 51% return. And again, the reason that happened is because the volatility crushed. It went all the way down there, and we didn't get much of a price move. This is the reason that earnings are a crapshoot, and you really need to understand what happens over the past to gain some kind of confidence on what's going to happen in the future. And it is one of the core reasons that I look at history and make a decision based on history and whether I'm going to play earnings with a straddle type of strategy. If we go back to the 4/27/2015, so we're going back a couple of years, you can see each earnings using that straddle strategy is we actually don't have consistent results. We got 1, 2, 3, 4, 5 losses, and we got 1, 2, 3, 4, 5 gains. So we got 50% winners and 50% losers. But if you add up the ROI between all of them, they actually add up to a negative 27%. What that tells me is that there's no consistency. This is the reason that I don't play Apple earnings. The second reason I don't play Apple earnings is because I make more profit on the Green Goose system. There's no reason for me to go after something that's all sexy with a straddle on Apple when I can make more profit on the Green Goose system. So what I'd like to do actually is announce that we are going to be holding another basic options training with the Green Goose system starting from November 3rd all the way through December 14th. It's once per week for about an hour and a half to 2 hours. We have the syllabus here. We're going to be going through a lot of different concepts starting on Friday evening. Money management, basic options concepts, technical analysis, so on and so forth. You can see the syllabus here. We're going to be talking about a lot of different strategies, and we're going to be using Tom's options tools every week to demonstrate each one of these types of strategies. Parallel to the entire course, we're going to be trading, or I'm going to be trading, as you look over my shoulders, the Green Goose system. And we've done that over the past 12 months, and it's been very, very successful where students watch that. The rules are released layer by layer as we go along over the 6 weeks. So for each new group, I establish and provide visibility of my trades in a separate $5,000 account. And then those rules are revealed one at a time. At the end of the course, students may trade this if they like, if they're comfortable with it. It's up to them. Okay? So these are the results of the past 5 groups, as well as some personal results that I've had since September. Group 1 did great, 113.7%. Group 2, we did a little bit less at just under 68%. Group 3 from March and April did 177%. We got 118.71% for Group 4 in May and June. July, we did a little bit less. It was a tough period, but we still managed to eke out 62%. And then my personal results, trading Apple in September and October, have been 400% account growth in 26 trades. The system is consistent, repeatable, and very much rules-based. Okay? So for this next course, we're going to be actually trading 2, or I will be trading 2, or providing examples of my trades of 2 names. I'll be doing SPY and Apple. So I'm very much looking forward to doing this. This is going to begin, again, starting on Friday, November 3rd at 9 p.m. Wall Street time, or actually we could go to 8:30 p.m. Wall Street time. We'll make that decision, and we hope to see everyone there as we pile forward. Thanks much, and have a great trading day, and I hope that you enjoy Apple earnings as much as I do, and we'll see you on Friday.